Hey everybody, welcome back. And on this edition of Terminology Tuesday, we're going to talk about two terms that always get people a little bit confused and also come with some acronyms to help you remember them. I'm going to talk about debt to income or DTI, as well as loan to value, LTV. So go ahead, grab a pen and a piece of paper and your favorite beverage, and we'll be right back to get into it. See you in a second. All right, folks, welcome back. We're going to go ahead and get started with this episode of Terminology Tuesday, talking about debt to income and loan to value. So I'm going to turn it over to my main man, Travis, and he's going to go ahead and talk to you about debt to income. So, Travis, please tell the folks, what is debt to income and how does it affect them in the mortgage buying process?
You bet. So debt to income, DTI. Those are the letters you're going to hear from your loan officer most often. That's going to be the first thing that I want to clarify because one of the biggest pieces of going through this process as a first-time home buyer, especially, is you kind of get overwhelmed with all these letters and numbers that get thrown at you, and everyone always just assumes that you know what it is. So moving forward, debt to income, DTI. All right, so we clarified that for you. First thing I want to talk about is this is going to vary from program to program. That's why it's very important that you reach out to either Ortez and myself or another trusted mortgage advisor to really walk you through how your debt to income will be calculated and most importantly, where your thresholds are for your individual program. So the focus today is going to simply be what is debt to income. Debt to income, quite simply, is the debts in comparison to your income. Now, when we talk about income, we're always talking about gross income, that beautiful number that we all don't even know exists before the taxes. That's a huge piece of it. Someone making an annual salary of $120,000 a year would make $10,000 gross monthly income per month. Now, when we compare that to your debts, we're going to talk about a front end or housing ratio and a back end or total ratio. So essentially, your housing ratio is how much does your new payment make up of your monthly debt to income, that front end ratio or housing ratio. In our situation that we're discussing currently, let's just say our client makes $10,000. Let's just say we have a mortgage note, including taxes, insurance, mortgage insurance of $2,500, $2,500. In that situation, the debt to income or DTI on the front end would be simply 25% because the $2,500 per month on my new home in comparison to my $10,000 in gross income per month. Now, if this same client has, let's just say they have a car for $500 a month, a student loan for $100 a month, and let's just say they have a handful of credit cards where the minimum payments add up to $400 a month, making their total debt obligation outside of the home about $1,000 a month. We would say that that 10% is added to the 25% on the front end or housing ratio. That person's total debt to income or DTI percentage would be 35%. Now, with most of your programs where there's no home buyer assistance and things like that, a total ratio and total debt to income figure of 35%, 99% of the time, as long as all other items line up, you're going to be in a pretty decent spot and you're going to be well qualified. So, again, debt to income is quite simply your obligations, current, and your future housing payment added together, taken out of your monthly income. That's how we come up with your debt to income percentage. Did I hit all of the topics there on that one, Tess?
I'm sitting over here just shaking my head in agreement. Yes, I believe you touched bases on everything because there's nothing that I need to add into regards to debt to income. But as Travis said, just make sure you double check because every product has a different DTI threshold. That's the only thing I would probably add or piggyback on how important it is for you to know that for your loan program. And I guess I'll go ahead and jump in on my topic. I,
One
I,
second, Tess.
what up? What up? What up, Trav?
So we've been doing this for a very short period of time.
Yes, sir.
And I think that that's the first one that I've absolutely just crushed. Can we please get a little bit of feedback from the audience? I mean, are they happy? Are they
I mean,
cheering for me somewhere? Can I
I
hear
don't
it?
know. I don't know.
I, uh,
Sorry, ladies and gentlemen. He
now,
really just wanted me to do that just so we can have some sound effects. I was just playing.
now, it's all you, Tess.
All right. Well, I will go ahead and step right into it. We're going to talk about loan to value, and mine is actually pretty simple. So, loan to value sounds how it is. It is whatever the loan amount that you're going to take out on the property against the value of the property that you're taking the loan out against, right? So in regards to like a purchase per se, the value is going to come from one of two places. It's either going to come from the appraised value that an appraiser says that the house is valued at, or whatever the purchase price is, whichever is lesser. All right. So that's your value of the property, right? In a refinance, it's simply the value in which the appraiser says your property is going to be. Now, the loan amount will vary depending on how much money you put down in regards to a down payment to come up with that loan amount, right? So, for example purposes, let's say a client is willing to put 20% down in regards to a house. Now, let's say the property is valued at $100,000 and that client is looking to put down 20%, in this case, $20,000. That means the loan amount in which they want to take out for the property is $80,000. So when you take that $80,000 divided by the value of the property, which is $100,000, you're going to go ahead and have an 80% loan to value. So LTV is pretty simple. The only confusing part probably when it comes to a purchase side would be where you get that appraised value at. Now, if we go by the lesser of the purchase price and the loan amount, the appraised value is higher, that means, folks, you have equity in the property. So that's a bonus for you when it comes to a purchase. And then always whenever we have a loan amount, we would always love it to be higher than what we expect it to be, just because, we know how times are now, especially with back in the day during the crash, they were overvaluing properties and things of that nature. So having a good appraisal really, really helps, and making sure that the appraiser is a quality appraiser is always key. But when it comes to loan to value, it's pretty simple. It's whatever the loan amount is versus the appraised value of the property at hand. And then I think the only thing maybe I would add is you may get property inspection waivers, which we'll probably talk about in another video, but that's when the powers that be determine that the value that you've estimated it to be accurate. So appraisal may not be needed. So that's why it might be waived. But other than that, loan to value, like I said, it's the loan amount against the appraised value of the property. And I'm going to ask Travis, but because I don't need any applause, did I miss anything in regards to loan to value that might be important to the folks that you want to add?
Oh, I thought you did a great job as well. I will applaud you myself. Very great job. You hit all the topics. One thing that's important to note, I actually just went through this personally a little while ago with my own personal home, is many times if that house appraises high on the purchase side of things, how long do I have to wait until that becomes the value? The golden rule is people will start to look at a home value. Let's just say you'd like to get mortgage insurance removed, like we just recently did. They're open to looking at it at about 12 months. So oftentimes you'll get someone whose home will appraise significantly higher, and they'll instantaneously think that will have ramifications on their mortgage insurance. And they're right. However, they're not instant, because remember what Tez said, we're always going to use the lower of the purchase price or the appraised value. So great job, Tez.
Well, thank you, my brother. I appreciate it. So, folks, I think that's going to wrap up this episode. As always, if you found this information to be useful and value, please go ahead and hit that like button, hit the subscribe button, as well as that bell notification, so you're always up to date on whenever we upload new content in regards to this mortgage knowledge that we hope to increase for you. With that being said, I'm Tez. This is my main man, Travis, and we are your favorite LOs. Until next time, folks. See you.